So Farhad, we're here in January the 6th, 2023. Let's talk about how peak season went. Obviously, we're still in January sale period at the moment, but how was pre-Christmas trading?
Overall, with all the doom and gloom that was being talked about in the run-up, for our clients, it's been pretty good. And I'd say it's slightly better than expected. When we washed up post Black Friday, we were sort of talking about how good November had been and how that normally impacts the December in terms of it being a little bit weaker. I don't think we really saw that. I think there are some external factors that helped along the way for the clients that we've got. Obviously, the weather was terrible for a big chunk, so particularly some of the fashion retailers had a very good couple of weeks. Those in the product categories that you would expect to do well over that time frame. Footfall was certainly a little bit lower in the run up to Christmas, and the sales, there's more of an impact about COVID and flu and less people going out to do those things. So online seems to have benefited a bit from that at the same point in time. I think we've been sort of luckier in some sense that we haven't had any clients that have had massive issues with overstocking, like you've seen at places like ASOS in particular, or I mean, Sweaty Betty, obviously a former client of ours, have been on discount for 60% for weeks and months, and you can see that they're not able to shift that stuff. I mean, it would help if they probably did other stuff than Facebook ads, but hey ho. So I think we've been blessed with that. But again, if you look across the sector, Next has reported really strong numbers. Primark reported strong numbers. Everyone, the stock markets opened all up on the retailers on the first day based on Christmas trade. So I think across the board, there'll be a lot of people that have done a little bit better than they were expecting to. It's a bit too early to talk about sales now in terms of January and clearance, because actually for a lot of our clients, they did quite well. So there's a little bit less pressure in terms of volumes that they need to clear. So that's going to be interesting to see. But yes, from a combination of, I think, getting a lot of the strategy right in the planning and execution of the marketing activity, clients actually getting a lot of the stock side of things right, a bit of help from the external environment across the board has produced a better than expected outcome.
Yeah, and I think you're right. I think the weather certainly contributed with that snow in the sort of last week building up to Christmas, didn't we? And the train strikes as well, which forced people online to some extent again, and obviously reduced the footfall in the high street. And it didn't feel like there was too much discounting, actually. I don't know if that's true.
Yeah, not as much as we sort of expected, and particularly with that. I mean, there's always two viewpoints. I look at this. I look at what our client base are doing, and I look at the wider environment. And within our client base, no, certainly wasn't necessary in terms of what happened to be there. I do think fashion would have had a harder time if the weather hadn't have turned quite as awful as it did for periods of time. But hey, that's the way of the world. And like I said a little bit earlier, there are obviously some people out there that have overstocked. And those are the guys that are really running very, very hard at trying to clear some of that down in terms of getting the cash off the books or onto the books for this year. And so I think that skewed things a little bit. But that said, I think if from the roundup I've had with most of our clients so far in terms of touching base, it's been a kind of we're quite happy and quite positive with the outcome of what's happened over that trading period. Obviously, we're all preparing for whatever the fun and games that happen to be next, which I'm sure we're going to talk about at some point soon. But yes, I think that the blend of things we've got right, particularly the media mix in terms of what we were doing, those that I've seen struggle actually have been they've either been too overstocked, or actually some of their execution around marketing has been so narrow in terms of what they've done that they've just overblown the frequencies on ads on the same people over and over and over again. And that, I think, has impacted quite a few. I mean, to be honest, the inquiries we've had in over Christmas and pitches for this year, it's all already, November, December weren't very good. What did we do wrong? And that's the thing that's sort of coming to fruition is actually that really narrow focus on too many DR things over that period, and not planning properly in the run up to how you create demand. And luckily for us, I think a lot of our clients did do that and did do it right, or did it pretty well. And so we haven't seen those sort of impacts come through. So yeah, I'm pretty happy.
And was it pretty even decent performance across all categories, or were there some? I mean, obviously we know fashion struggled a little bit, but in other areas it's been pretty good, right?
Yeah, I mean, fashion struggled a little bit, but it was struggling a little bit anyway because of the changes in behaviour, but better than expected. But and we had clients that were up year on year. It might not have been up much, but still up, which is exceptional performance. Beauty's done quite well. All in all, most of our beauty retailers have done well, but across the board, actually, Jim, everyone's done at least okay.
I guess it all comes down to how you measure, right? It comes down to how you measure, because like if you're talking about revenue uplift, a lot of that's inflation is fueling that, right?
Yeah, there is definitely a part of some of the revenue uplift is partly inflation, and there are people where you need to look at actually the scale of transactional volumes versus the scale of revenue volumes, and in all cases revenue has increased. Probably all cases, revenue has increased further than the transactional volumes have. However, that said, we still have a good bunch where transactional volumes are up year on year, which in this environment is surprising. And actually for some of the retailers that are not cheap and don't discount that heavily. So I do still think it points to there are some people that still have money, and there are some people that are still willing to spend that money on the things that they actually want to have. And it's just getting your planning right to understand how you reach the right people that are there. And I think that's the bit that we have done quite well over the last few months is, everyone's been a little bit tighter with budget. And actually sometimes being a bit tighter with budget is a helpful thing because it narrows your choices into the absolute right things to do. And so I think that's partially in some cases helped as well.
Okay, so we are in January. It's traditionally the sales clearance time of the year. We talked about overstocking, but I think the interesting thing when we talk about this time of year where we start planning for a lot of clients, and you sort of hinted a little bit at some of the brands or some of the other clients that we're not working with are very focused on too fewer channels, and too over-reliance on DR or historic channels that have worked in the past. But so things are changing pretty rapidly.
Yeah, and I think that you need to look at the bigger picture and the media environment that we're about to go into, right? So there is, whenever you get into environments that are recessionary, there'll be some clients that want to cut back what they spend. There is almost always an over-reliance on going a little bit too direct or trying to keep everything direct, which just doesn't grow. If you're a big enough brand, you're going to have trouble maintaining that over a period of time. But the reality is there are also changes in the media environment in terms of what's happening, particularly with TikTok's the big one in the mix in play that needs to be shifted around, but also around VOD and other areas. But the reality is also most money still will come out of ATL, which means that actually investing in your brand, it's one of the cheapest opportunities. So as long as you can take a slightly longer term view about what you need to achieve, then that can be quite helpful. I do think it will be interesting this time around to understand what comes out of digital and how that impacts rates in the digital environment, given that 75% of all spend is now something digital orientated in some way, shape or form, which hasn't happened in previous recessions. You've almost had this duality of kind of going, here's one part of the media world that gets really whacked, and here's another part that actually just keeps chugging along in the same way. I don't think that'll be the case this time around. So there's definitely going to be, for those that are braver and bolder, going to be opportunities around cost and cost efficiency. That means that you can do more in those spaces. But the truth of the matter is, when we saw it before Christmas, there are already retailers that are going down the toilet from over expansion, over COVID, or actually not being able to shift product. There are going to be other casualties in that space, and they're probably coming towards the end of this month if we're being absolutely honest about it. And actually the ripest thing is going to be too much offline infrastructure, which has been a bone for many people for quite a long time, and this time around too much money is tied up in stock that they need to clear out. So yeah, it's gonna be an interesting sort of few weeks, but I expect that there's going to be a bit more of a shakeout of some names that we all know quite well, that are gonna have a bit of a struggle to survive or end up being bought out by other people in the kind of shape that we've seen for the last year or so.
And then, that endless debate about brand versus performance investment in a recessionary environment, and the classic argument that actually it's a great opportunity to grow market share at a time when people aren't investing in their marketing.
It is, and I think that's the reality of that piece is you've got to understand that, and this is the hard thing about business, isn't it, is that payback is unlikely to be in this year. If you make that investment in this year, your payback isn't a 1 year payback in terms of putting money on the P&L. The payback is likely to be over a period of time, and actually your growth that you accelerate when you come out of this in 18 months time will be faster and bigger than everyone else. So we'd be lying if we also said we don't have the short-term challenges about money, revenue, P&L, and all the other bits, because we all have them, right? We all have what that happens to look like. However, that said, what I do find interesting, and even for one or two of the people we've started speaking to early in this year, is you look at the size of some of the direct response budgets that they've got, and there's too much money in there because they think they can measure it in a way that is effective at measuring that piece. But actually, when you look at genuine incrementality, actual frequency, how that fits within the media mix, you're better off understanding how to rephase the money you've got. You don't necessarily need to spend more. In fact, sometimes you can even spend less. I'm not going to mention the client, but there's one where you can see that actually the impact of spending a lot less is going to mean that actually some of the things that really didn't make sense for them to do are going to come out of the water, whether that's a combination of being smart about media choices, being smart about targeting choices, audience choices, and a combination of all of those things, you can see is going to make a big difference to the efficiency of what they're trying to do and what they're trying to generate. So I don't, everyone gets into this doom and gloom bit about, all the agencies talk about you should invest in a recession, and all clients go, no, we're stupid, we can't. Yeah, I get that. But the truth of the matter is, for a lot of people, certainly at a reasonable size, it's not even about investing more. It's actually about understanding how you reshape what you're doing to be strategically more intelligent around the changing environment and what that can yield for you over both the medium term and the long term. And that's where I think that people who think about this the right way and execute it the right way will be the ones in 18 months when everyone's looking at them going, oh, look how quickly they're growing. Wonder what they're doing. And it isn't what they're doing, it's what they did. And it's what they did 18 months ago that really matters, not what they're doing today. And by the time you look up, it's too late. And you want to be one of the guys that everyone's looking at rather than the kind of the guy going, what are they doing? Because you've missed it.
And this is the battle being fought around every boardroom table between finance and marketing or sales, right? So this is going to be an ongoing discussion for the next 12, 18 months for sure.
It is, but I also think that the other part to this is also going to be that we've touched on it. There are some people that have done well. There are some people that are struggling. It's those that are doing well that have the money to invest at this point in time to accelerate the shape of where they're growing, right? So actually, there's a little bit for where if you're one of the strugglers, you need to take this wider strategic kind of viewpoint of actually, if we don't find a way of reshaping what we're doing, we're done. And to be honest with you, if I look at one or two of the examples from last year that have gone down the toilet, it is simply because they were too slow to reshape what they were doing across the board. I'm not just talking about a marketing piece, but I'm talking about supply chain, stock, infrastructure, far too slow. And I think the other thing, and we're seeing it in tech, aren't we, is the lots of people have got the predictions around how quickly online is going to keep accelerating wrong, and have overinvested at points during the pandemic, and that's going to start unraveling itself. I think the important thing to bear in mind is that was an overinvestment, and we're getting back to a more natural place in terms of where things are and where they should be. It's not actually looking at the piece of pie going, actually there is a massive downturn, because there isn't a massive downturn for where that happens to be. It is actually strategic decisions being got wrong about the pace of acceleration. For me, those are different things.
And the platforms have made those same mistakes as well, which you can tell from the sheer amount of layoffs that have been announced in the last week.
Yeah, absolutely. I mean, there's the Amazon announcement, I think yesterday, which should double down. But I think that the interesting thing is when you look at all the platforms is they've all got their challenges. Obviously, Meta is very much about how much money is going into the metaverse type stuff that they're doing. But even Google's been an interesting one to look at, where shareholder pressures basically said, look, what's going on? your margins are cut in half. You're growing like crazy from a revenue point of view, and you're just spending too much money. You've got too many people, you pay them too much money, and not enough of them are producing revenue. Why should I accept as a strategic investor that as you've grown, my margin is halved? Go away, fix it. And I think, you know, there's a lot of those in the space, and they don't have a choice now that their share prices are under pressure, right? So that's just a natural correction within a particular sector of over exuberance that we've seen in those sectors before, for you and I anyway, not necessarily for everyone else, but we've seen it before, not like this. But I don't think it's an underlying symptom of actually what's going on with the broader economy.
Okay, well, we steered away from the initial chat we were going to have, but an interesting one anyway. But so well, let's catch up again in I don't know, 6 weeks time, because I think we'll be very much in planning phase by then, won't we? And
yeah, I mean, we'll probably be half to 3/4 of the way through planning phases, depending on how people's financial years kind of fall. But I also think we'll have it's a strange time, January, isn't it? Because, you know, of what's happening. February, March, April will give you a much better steer in terms of predictability of how the year is likely to go, although I'm loath to do anything to do with predictions these days.
Yeah, well, let's catch up in like mid-February and see how that's going and how those conversations with clients are going too. But thanks Farhad, useful chat.
All right, Jim,
we'll catch up soon.
All right, mate, cheers, bye.